Good afternoon. Welcome to the Orlando Real Estate Buzz. Bran Reno with the Homes in Orlando team, and joined as always by Joseph Deon from Appley Home Loans.
I'm excited. It doesn't feel like there's a lot going on. What are you talking about? My beard? It's all clean.
Yeah.
It's clean. It's not scraggly. Like I don't have like a neck beard going on. This is not common for me. It's like I feel like right now I should have all that because the markets are kind of wild and all over the place.
Yeah.
But I feel like we had some really good economic news the last couple of days, and markets are still in a sell-off. Like it's interesting.
Yeah, it hasn't gone the way I thought it would go. I mean, we've got a couple things happening, which is, both the CPI and the PPI did a little bit better, right?
Yep.
The Europeans, though, their bond markets are headed totally opposite than the way we headed. Interesting news about Orlando foreclosures that came out.
Ooh.
Very interesting there.
Ooh, I'm curious.
And then the Aura numbers were actually a little bit better than we had thought.
Okay.
Which was nice to see. It was really nice to see. But let's hop in right off with what I thought was going to be a much better overall response in the market, which was today the producer price index came out.
Yeah.
It beat expectations as well and down quite a bit from last month. So, it's what a lot of people may not realize is producer price index is kind of a foreshadowing of what may come with the CPI. So if the producer's costs are coming down, then the consumer price index should be coming down as well. So we're looking at this and you're just like, okay, I mean, that really is some good news overall. Nothing went too crazy. It wasn't like a super big savings, but still the fact that we came in under expectations, I thought was fantastic.
Yep.
And then yesterday, consumer price index came in, still higher than what the Fed is looking for. It's still higher. 2.8 is not their target of 2. But when you beat it a little bit, usually we get some kind of rally someplace.
CPI came yesterday and we didn't. Guess it was a strong day on the markets. And then you had PPI come today, which was a positive reading. And I would have thought we would have continued to see a similar trend. We didn't.
We didn't. We actually started out the day in the opposite direction, which was really kind of like, because there's some things that looked really good. I mean, one of the main ones is our energy cost, which really that hits everybody. And we're still in the Northeast anyways. They're still getting hit by winter storm, but our fuel, look at the fuel oil, came down 5.1%, and gasoline has continued to slowly start to come down. I think the price of oil, if I'm not mistaken, has dropped maybe to about $65 a barrel. So that overall seems to be some really good news for costs moving forward. But it's not affecting our treasury yields in the way that we like to see them anyways.
I mean, we're starting to see it to go back down. I mean, it kind of yesterday went up a lot.
Yeah.
It felt like we had a big bump up yesterday, and we're starting to pull back a little bit today, which is good. But I always say this, like when you look at it for mortgage-backed securities, right? Like, so it's kind of the inverse of the 10-year, right? Like the 10-year T goes down, mortgage-backed securities go up. And that means lower interest rates for us typically. But the problem that we found here is that anytime you see big movements one way or the other, like investors, lenders, the people that are determining where we are on rate sheet, they're very cautious to be like, oh, we had positive movement. Is it going to stay? Because we see how fast it whipsaws the other direction.
Oh yeah.
So
I mean, if you look at just a straight 5-day graph, I mean, we're up, we're down, we're up, we're up, we're down, we're up, we're down.
And when you see that, and you look at that 5-day, look right just before, you got today, but you go back a half day, right?
Yep.
Or you go back to this morning even, right? The 313 earlier, and you're talking, okay, well, everybody priced way up here, right? They're not going to come back down here because now they're going, look at what we've done. We keep going up. So they're going to say, let's hold off and see. So that's the hard part is it's like, even though we see the movement back, everybody's kind of already hedged to the cautious side.
Yep. And I'm wondering if this little bit of rally we're seeing right now may be due that, I mean, literally in the past hour, Putin came out and said that he agrees to the ceasefire. I think is fantastic news.
It's
I don't think we need the war.
I agree.
We really don't need any. I mean, I heard some of the numbers, and that's a lot of people's lives to lose.
And it's a lot. It's really interesting because you see a lot of this context, and you see the ceasefire happen, but Trump with the Ukraine, and he's like, hey, we're gonna hold off some of this because aid and monies and everything, and then all of a sudden attitude change, and the argument could be like, well, did you chop off Ukraine's needs by removing aid, so now they're not in a position to really negotiate? Or did you sit there and get them to a place where it's like, oh crap, we can't continue the war just to continue the war, so maybe we need to talk peace more aggressively? It's really hard to tell. But I think coming to peace terms right now, a 30-day ceasefire, it's not full on peace, but a ceasefire, that's good. That's the right direction.
Yeah,
you can't look at it as
definitely the right direction. Definitely the right direction. But it's interesting how it's affecting our market as compared to the European market, because what we've seen is over in France, they're coming up on their bond ratings, and they're being threatened to have their bond ratings cut. And today, you've seen the French 10-year bond hit almost a 14-year high in their bond rate. So they're headed in the complete wrong direction. But you're looking at a lot of these European countries, and all of a sudden, the way Trump has approached it is you guys got to start paying your fair share, and you've got to fulfill the commitment that you've made, especially with NATO, which is 2.5% of your gross domestic product, which most of them are not doing. And we're seeing the same thing over in the German 10-year bond as well. They have spiked. This is just within the past 5 days here. They have jumped almost over almost 0.375%. So you've got a lot of things happening in the market right now that are really pulling one direction one way, pulling one direction in the other way. And I think we're going to continue to see that. And one thing I've noticed, and I've heard several people mention it, is Trump has really kind of taken a different approach to the stock market than he did in his first term. If you remember, in his first term, he kept talking up, stocks, stocks are through the roof, stocks are through the roof. Now he's kind of like, they'll take care of themselves. They'll take care of themselves. And I've seen several of his people come out, including the Treasury Secretary, saying, hey, to get our house back in order, there's going to be a little bit of pain. There's going to be some short-term pain for the rewards that we're going to get. And I kind of ran a thing through Chat GPT today, just because I was just curious, because Elon's saying he wants to cut $1 trillion in spending, and I wanted to know how would that affect our overall gross domestic product. And I didn't know they actually have different levels in how they count it. There's you can up it 1.5, you can par it, or you can do like a half of it, how it actually affects the overall GDP. So I'm like, I didn't know that. That's different. But overall, they estimated that it would actually turn the GDP negative by taking that $1 trillion of government spending out of the system. And I don't know if you saw the Atlanta GDP projection, it went negative. It actually went negative, and everyone panicked. So I'm like, okay, some people say it was because people were loading up on product before all the tariffs start to hit, but I'm wondering if it's also they're projecting, okay, what if they actually do cut all this out? Because even if they cut out $500 billion, that could be a 1.5% hit. So we could have literally, quote, zero growth. Kind of interesting, but
very interesting.
The one thing Chat put out, which is I agreed with them on, is that overall, if it is done, it will take and reduce our interest rate, which is what we want. We want the interest rates to come down so that more people can afford a home. So, and we're in that little seesaw right now. It's like I thought we were going to break it. I thought we are going to break it. I thought with CPI news and stuff, I thought maybe we'll get right down close to 4, and it has heated up a little bit. It's a little bit more heated, and we'll see that from the numbers. But I think that would have been just enough push. Still, some of these people who are sitting on the edge to jump back in. So, but then one of the other things that came out, I almost missed this. This really surprised me, that foreclosures in Florida just absolutely spiked the end of last year. And
I mean, and I know that's a spike, but I mean, 250%, we've been at the lowest foreclosure rates that we've ever been. So like that's a big pause, but 250% is still 250%. Like, do we know the numbers? How wait, number
they
one
actually didn't provide actually
one in every 172 homes foreclosed on. That's interesting.
That's in Lakeland.
In Lakeland.
Yep. Lakeland was the number one in the nation for filing last year.
So 0.6%.
Yeah. So
I mean, that's still a lot.
Yep. Then Orlando is number one in foreclosures for populations of 1 million or more right now. So I think, some of it, did some of it have to do with the hurricanes? Yeah, I definitely think it did.
Yeah.
There's some people who probably just turned around and said, I'm out of here. I can't anymore.
Yeah. I think you probably had that. Or if you had damage, people are like, I gotta pay to stay somewhere else. I can't deal with this. Insurance, figure it out. Like, house is destroyed. Sure. But Orlando's an interesting one because Orlando wasn't really impacted the same way by the hurricanes as, maybe Miami. I don't even know. I feel like Orlando, Jacksonville, Miami, we're talking. I felt like if it was golf, I felt like that would be a lot worse, make more sense to say the hurricane. But I think overall, Orlando, Jacksonville, Miami, we weren't too like, there was some damage, there was some bad, like, yes, there's some people that really lost a lot, but overall it wasn't as significant as it was along the Gulf. So I don't think the hurricanes played as much of an impact on those three metropolitans as it might be foreshadowing it.
Yeah. I mean, I can tell you, I've actually seen short sales start to pick up. I've got a couple right now, and that's coming from the people who bought at the very peak, and now all of a sudden are having to move. I've got one who literally bought his house 2.5 years ago and had to move and just couldn't handle 2 mortgages in 2 different locations. So we're actually working with him on the short sale, and the other one, again, is a VA where the gentleman did 100% finance, and he bought in a new development.
Oof, yeah.
And it's so hard to sell a house in a new development when you can get all the benefits from the builders and a new home. To have to sell that within 2 years of your purchase, and they're still building out.
Yeah,
that makes things extremely difficult to do.
Yeah. You're like, okay, my house is 500, but you can buy from the builder for 520, but the builder's going to give you 30,000 in closing costs, and they're going to give you an interest rate 1.5% below market.
Yeah.
Like,
and we see all the advertisements today is, builders incentive here, incentive there, incentive here, incentive there. So, I think we may not see the foreclosures, but I think we are going to continue over the next year or two to see continued increase in short sales, where they had pretty much disappeared they really did disappear during the COVID period. Whatsoever, Oh, but this is, I had to keep this one for you because this came up on my Facebook feed from 5 years ago. I thought you'd get a kick out of this one. Remember this one?
Oh man,
I saw this one. I'm like, I got to throw that one in on the show today. I remember that's how everybody felt was, can you see yourself being quarantined here? So, but going into our numbers for Orlando today, this was actually nice to see. We had 2 weeks in a row that for the first time in numerous months, we actually stayed above 400 sales for the week.
Wow, that's good. That's a long time.
It dropped a little bit, but still 426 is a great number to see overall. And we still did increase our inventory a little bit, 29. Our condos, they're just sitting right there at that 110, and the inventory keeps going up overall. And then we break back into our actual breakdown of the numbers. Our months of inventory, I didn't get a chance to go back, but I'm like, it looks lower than last week. And it may be because the number of sales have popped up. And since that's part of it, because we were holding above 5 months, and with the 2 weeks of increased sales, it's actually brought the months of inventory down a little bit. But then again, on our original to final sales price percentage, we're still holding that 93.5. And if you look at that, the under 250, if somebody gave their house away, we're at 84%. So someone needed to get rid of a house there fairly quick. But there's still room over that hasn't moved much, that there's still room in there for deal. And because even the average days to contract at 78 didn't move at all. So our days on market is continuing to be the same, but having the increase in sales, I think that's what's brought down our months of inventory. And as you can see from the graph, there it is, 2 weeks in a row above that 400 mark, and it's pushing our average up, because we were down almost to under 300 on the period average of sale. And it's still lower than typical this time of year. March usually is when you really start to see things kick off. We got spring break. I know my boys have next week off. So the next 2 or 3 weeks, if we can find a way to get that bond yield down a little bit, I think we could actually have a fairly good spring, better than what I think a lot of people expected.
Yeah, I agree.
And then just, inventories still growing, not quite as much. We're up about 11% over the first of the year, and days on market is still holding pretty steady in that 70-day range, somewhere in that ballpark. Then condos, just keep growing. We're almost 9 months of inventory on our condos, right? And original to list, we're holding at 94%. Average days on market, 79. So the condo market just really isn't going much of any place, and I just don't. That's just one area I just don't see it for a while, especially with the cost of the HOAs or what's happened.
In that with market. Everything that's happened with them, they're kind of stuck, and it's going to take years, I think, for the condo market to correct itself.
I think it will too. It's one of those where, I hate to say it, it almost has to inflate itself into a comfort zone where, hey, if I'm paying $300 a month for an HOA and I've got this versus a house at this, there's a much bigger difference than there is right now.
I think even if we see with condos, I think even if we see single families and homes continue to go up, I think you'll see condos go down in value.
I agree wholeheartedly. And I think if the single family market heats up a little bit, I think that may push some people who are considering a condo may say, okay, well, I'm having a tougher time finding a single family home. Maybe I will for right now. I'll stick with I'll purchase a condo. So, I think that could happen very, very easily as well. So, but it was just kind of a quiet week, even with all the ups and downs, the back and forth. I mean, what was it, Monday or Tuesday was pretty funny with Canada. With Trump going back and forth. And then Europe had to get into the game, said, hold my beer, here you go.
We'll show you how it's done.
But overall,
now you have what, 250% tariff on EU champagne? I don't know.
Or is that what it was?
I think it was. That cracks me up. But we'll see a little bit. But again, I think a lot of what we're seeing right now is, I think it'll mellow out and it all fizzle away at some point. But those are going to be things that could have an impact on inflation. And we're not going to feel it today. We're going to feel it 2, 3, 4 months.
Because the tariff numbers really haven't.
Exactly.
That's if they start in April, you're probably May, June is when we're going to start seeing those things hit. So we'll see if they're able to renegotiate and get some stuff done in a very short period of time, which I think everybody wants to do. It's just, sometimes you do have to shake things up a little bit to get what you want and reposition everything.
Exactly. We'll see.
That's all right. Well, thank you, everyone. Please like, subscribe, and join us every Thursday. We look forward to seeing you here on the Orlando Real Estate Buzz. Take care.
Okay.